So speaking of the Community Reinvestment Act, our next session is on housing and home ownership. And Jim Carr, who is the Chief Operating Officer of the National Community Reinvestment Coalition, will moderate this session. So Jim, too, has done a lot of great media work and exposing this myth that Janice is talking about all over the place. So we should all link our websites to that information. So Jim, come on up. And you can introduce. Just to say that originally we had wanted to have a congressperson at each of these sessions, and Mel Watt was originally going to be part of this session, but as we know, their schedules are so flexible that it turned out that we couldn't do it that way, so we sort of apologized for the last minute changing around of things. But Jim.
And I'm honored to have an opportunity to share some thoughts with you today about the racial wealth gap and how it got to be the way it is and what we can do to address it. And before I get started, I really would like to start off by thanking Kololo for this extraordinary opportunity. And I've told her this a million times before in private, so I should say it in public. This has been the most extraordinary journey that I have been on as a researcher, bar none, because it has given me an opportunity to really understand, to see, to appreciate, and to know an extended family that I didn't even know was my extended family. From First Americans, Native Americans, First Americans who share a history which is unique and different, but not anywhere any less painful and challenging, to our neighbors to the south, whose history is as complex and difficult and not any less painful and challenging, to Asian Pacific Islanders so far away as a child I had no idea that they even existed, and yet they were part of my extended family as an experience in this country. And being together and understanding how shared our experiences are, yet the unique and subtleties that make us different, has been extraordinary. And so, Kololo, we really owe it to you and your brilliance, and not just putting this gathering together, but keeping it going year after year after year, because so often we have such a short attention span that we have a conference and then we conclude, we've discussed everything, we've solved all the problems, now let's just go off to the new issue. And you have been so focused on the fact that, no, you haven't. You really have only touched the surface. And so the extraordinary receptivity we're getting from the press today, from the members of Congress, so many who are coming to share with us, is really a reflection of your stick-to-itness, and you're helping us to stick to it, because we haven't solved the problems, we've only scratched the surface. But at least in this conversation on this day of this week, we've scratched it enough such that much of America is now focused on our issues. So thank you. It would be an understatement to say that America's economy is completely in turmoil, the worst economic experience that we've had in at least 70 years. We've lost over $10 trillion of wealth since this crisis began. And we still remain, despite the euphoria of the stock market, in a vicious cycle. And that vicious cycle really, in large part, is driven by collapsing home values that is resulting in less consumer spending, also less consumer confidence that's translating into less consumer purchases, which is less productivity, which is increased unemployment, which is increased foreclosures, which is, yeah, you can figure out where this circle goes, falling home values. And in fact, the foreclosure crisis now, because of the inattentiveness of focusing on the core of the problem, has now morphed from a product-driven issue, which we have been talking about now for over 4 years now, into an unemployment-driven crisis, such that the 650-some thousand job losses last month has translated into potentially 260,000 more foreclosures. In fact, we are now expecting Despite the fact that over the last 2 years we've had 3.5 million foreclosures, we could have as many as 8 to 10 million more over the next 4 to 5 years. And anyone who believes that that level of foreclosures is something that this economy could withstand is in denial. Now, as many of you are aware, the crisis is being blamed on the benevolence of financial institutions that attempted to promote homeownership. One need only to look at the antics of AIG to see that Wall Street was not the paragon of social responsibility. And in fact, as the Congressman just stated, many are blaming the Community Reinvestment Act. Well, the Federal Reserve Board has already dismissed that argument. You see, all you need to do is recognize that about 6%, count them, 6% of high-cost subprime loans were to low and moderate income households were covered under the Community Reinvestment Act. So if you flip that around, roughly 95% of it had nothing to do with CRA as it relates to low and moderate income households in the subprime market. We know that what really happened was a Ponzi scheme that would make Bernie Madoff look like an amateur. Because this Ponzi scheme was the entire system in the subprime market, largely unregulated, from brokers to lenders, appraisers, credit rating agencies, all the way up through the investment banks. We had brokers who were abusing consumers with kickbacks in the field of yield spread premiums. We had lenders who were underwriting consumers and qualifying them at teaser rates rather than the fully indexed rates, who were not setting up escrow accounts for the consumers. We had appraisers who were openly and freely offering bloated house values. We had the rating agencies that were happily stamping AAA credit ratings on what was obvious junk. And we had investment banks incenting all of this misbehavior by paying very high premiums for high-risk products, which ultimately transformed the system into looking for consumers regardless of their credit backgrounds and transforming them into high-risk circumstances. To date, almost all of the intervention, almost all, and we'll talk about what's been done recently, but most of the intervention has been on the side of propping up financial institutions and propping up the financial system. And all along, we have known that this would not work. It was not a viable circumstance or a solution because the problem did not arise in the banks per se, but was arising in the kitchens and the households. It was a foreclosure crisis, and the foreclosure crisis has been largely ignored while we support the financial systems trying to keep them going while allowing the financial crisis called foreclosures to continue. And so many people right now focus on the TARP fund, $700 billion, and the public is just riveted on that $700 billion and worried about where the dollars are going. And most of the public don't know that over $10 trillion is actually supporting the credit markets, over $10 trillion. And what have we gotten for this $10 trillion? A financial system that remains on life support. And to put that $10 trillion into context, $10 trillion is approaching about 90% of all outstanding mortgage debt. All, not prime, not just subprime, but prime, subprime, and everything else, about 90%. And yet the percent of loans in delinquency or in foreclosure is a little over 11%. And it shows the inefficiency of the approach that's being taken. And the reality that helping the consumers going into foreclosure would have been a much more efficient strategy. Now, the problem that we have, of course, is that, as I said, the problem is morphing now. It was a product problem, and up through last year, addressing those problem products would have been pretty simple to help get consumers out of these high-cost products into long-term sustainable loans. But it's a lot easier to modify a high-cost loan than it is to help a consumer who just lost their job, because now we have to get them reemployed in order to avoid the foreclosure, and unfortunately, that's the circumstance in which we find ourselves right now. And so we now have the most comprehensive and thoughtful foreclosure mitigation program that has yet been put on the table, that was put on the table by the Obama administration just a couple of weeks ago, and it is a very thoughtful program. The challenge is that there are a lot of problems that it still doesn't and won't address. And so we have a lot of extraordinary experts today to talk about that program, as well as to talk generally about what this foreclosure crisis means to communities, and we'll dive into them. Before I introduce them, I'll say just a few more things about the nature of the crisis in which we are currently find ourselves. As one of the Congress members this morning pointed out, the unemployment rate is 8%. But as we heard yesterday at lunch, in fact, in communities of color, the unemployment rate has already exceeded what most people would consider to be the most horrific unemployment rate that we might reach during this recession. And that is the reality that unemployment for African Americans is just below 14%, for Latinos is around 11%, and this compares to just above 7% for non-Hispanic white households. And we know that even if we dig in and do even more disaggregated data analysis, the unemployment rate for young black men exceeds 20% already. We also know that in many of the communities that are most suffering now, they were already suffering before this crisis, already with every type of financial and socioeconomic distress. And so now when we're hearing the term neighborhood stabilization, what does that mean? Because many of the communities for which we were talking, remember, we were having this conversation before the crisis. We thought it was a crisis before the crisis. We were looking at neighborhoods that we knew were here, and we were saying, how do we bring them up? And the unfortunate thing is when you hear people say, well, we're on the precipice of losing. No, we're not on the precipice. We've already lost. We've lost maybe more than a decade or two, maybe 3, of community reinvestment dollars in many neighborhoods around the country. They are so far now underwater and suffering. The idea of stabilization is not, it's almost, I don't have a word for it. Because how can you stabilize something that was already unstable and out of control, for which we were meeting to fix almost 5 years ago? So we need to reshape the conversation around stabilization, really stop talking about that, and focus on recovery, because we really do need to recover. Now, that doesn't mean that we need to stop the damage first, because, and it has been said repeatedly this morning, you have to put a floor in before you start building. So we do have to put a floor in, but we have to be cautious about our language around stabilization such that we don't get the impression that stopping and stemming the damage, that's what we're looking for, because it's not. We first have to stem that damage and come back to the distress conditions where we were when we started this dialogue, and then carry that further. The good news, as we've seen today and yesterday through our conversations, through our discussions, through the media focusing on our issues, that America is listening. And thank goodness for AIG, because they really have helped America listen. Because the sort of the backlash to AIG is not about AIG, and all of us know it. It's that the AIG circumstance has finally slapped so many working families to understand and get them out of their denial that they are suffering and have not been participating fully in the economic rewards and benefits of this country. And the important piece, it's working families, non-Hispanic white families are right there with us now, and now they know what we have been experiencing for decades. And so we need to use this opportunity to build that alliance with those working families, those communities, because the truth is we all are in this together, and never has that phrase, we either work together or we fall apart, been more important and more true. And so I'm very thankful to have a distinguished group of panelists today to help us think through these issues. And in our informal format, the way we tend to do these, moderators do less leading of a conversation than inviting a conversation. And so I'm inviting a conversation with 3 extraordinary people. And I'm going to start on my far left with Aracely Panameno, who's the Director of Latino Affairs for the Center for Responsible Lending. And let me just put one point on the Center for Responsible Lending before I start about this crisis. It wasn't just predictable. We were all talking about it going back further than a decade, because the state of North Carolina passed an anti-predatory lending law in 1999, so we knew it was happening.
But the Center for Responsible Lending stepped up the game in the fall of 2006 and predicted 2.2 million foreclosures. And we can sort of map that as the beginning of the crisis, because then you can't deny it. And at that time, many people said, well, that's just the rantings of a nonprofit that's trying to scare people and trying to get legislation passed that shouldn't be passed. Well, now we know, right? It was a very conservative estimate, and if I had any critique, it was, why were you lowballing the numbers so much? After that will be Jose Garcia, who's Associate Director for Research and Policy with the think tank Demos, which has done extraordinary work as an institution, and Jose in particular has done extraordinary work on savings behaviors of consumers, and we look forward to your comments. And then finally, Jacqueline Pata, who's the Executive Director of the National Congress of American Indians, and we look forward to hearing your story. I always look forward in particular to your stories. They're the ones that I know are the most painful for me to hear, and the least that I know about, and I always feel embarrassed about that because you are the first Americans and you should be standing first in line. And I look forward for us to help you figure that unique puzzle that you experience, because your experience is so different from ours, and it deserves all of our thinking and all of the participation from your extended family. We'll start with Aracely.
Thank you, Jim. Every time I have the opportunity of speaking after Jim Carr, I sometimes wonder whether there is anything left for me to say. He does such a great job of introducing and speaking passionately about this issue. I thank you for inviting me, Mayu, to speak here today and to be in such great company. This is the second day of this conference. You've been having this conversation now for a while, and I'm sure that by now you will begin to hear the repeated messages of this theme and this conversation that didn't start yesterday, but like Jim has said, it started many years ago. If you haven't already, I encourage you to pick up Insight's racial wealth gap in business management, as well as homeownership and home lending. They are excellent summaries of the conversation that we are having here today. I want to start with basics and fundamentals. And so I looked up, when I was invited to speak here today, I looked up at the definition of wealth. And so the Merriam-Webster Dictionary defines wealth as the abundance of material possessions or resources, all property that has money value or unexchangeable value, all material objects that have economic utility. So we are talking about what? Money, stocks, bonds, retirement accounts, insurance policies, jewelry, real estate, property, family businesses, automobiles, and other personal property with a net value. And most of it is supposed to accumulate over time. And in my opinion, as a person of faith, God willing, once that is accumulated, passed on from generation to generation. In Spanish, we say patrimonio familiar. And so it's something that you pass along to your family from generation to generation. The people that have spoken to you already, and those that are here on this panel with me, have already talked about the historical context of wealth creation in our nation and around the world. They have spoken to you and will speak to you about systems designed to benefit one segment of the population while purposefully denying access to the rest of us. I want to place emphasis on the word designed. This means that as we look to the future, we have the capacity to imagine and redesign systems that provide equal opportunity for all. But before I go on to the punchline of my remarks, I want to make sure that we do not obviate that wealth defines more than intergenerational material possessions. Wealth has a host of social benefits associated with it that it helps perpetuate. It helps perpetuate people's ability to acquire it, right? So I'm talking about access to health, education, meaningful work, upward mobility, less teen parenting, less criminal behavior among youth, higher community involvement, higher civic engagement like voting, elections, in diversity in political candidates that lead to positions of authority and decision-making which impact the lives of others. Wealth creates a cycle of well-being and should be attainable by all. As Jim said, my name is Aracely Panameno. I am the Director of Latino Affairs for the Center for Responsible Lending. CRL is a nonprofit research organization that works to protect homeownership and wealth and asset building through the elimination of abusive financial and lending practices from the markets. We are affiliated with Self-Help, one of the largest community development financial institutions in the country. I don't have to remind you, because Jim already did, that we face great economic challenges. For some of us, the greatest we have ever seen in our lifetimes. We did not get here by chance. We got to our current state of collective economic failure through practices implemented at the individual level, consumer by consumer, but that aggregated represent the end of the economic world as we know it. And it should be the end of the economic world as we know it, because it was wrong. Racial discrimination in financial markets has been in place since the idea of financial markets was first conceived. So as we go through the pains of this imagining and redesigning period, we must heed the lessons from the past that we may not repeat history in the future. So what does CRL do? We study predatory lending practices in financial markets. And so abusive lending steers and steals from borrowers, from consumers, more than $25 billion every year in products like payday lending, which takes about $4.2 billion, overdraft loans, $17.5 billion, in mortgage abuses, $9.1 billion in fees, $164 billion in foreclosures, and I think that that number, as we've already agreed, is actually obsolete and was off the mark, Jim. $356 billion in spillover in terms of the continued devaluation of homes, neighboring homes in various areas of the country. I'd like to mention to you that there are some lessons that we can take from battles that have been fought at the state level. Mentioned already was the case of North Carolina and the anti-predatory lending law, which was at the time the strongest anti-predatory lending bill on mortgage origination in 1999. Most recently, last year, we had a number of victories in the state of Arizona where the payday lending industry had actually gotten an exemption from small loan caps for a period of 10 years. And in order to circumvent the sunset of that particular carve-out, they decided to put a ballot initiative during the election cycle. And they named their ballot initiative Payday Lending Reform to deceive the electorate, counting and banking, literally, that the consumer would not understand and that the word reform sounds so good that people would actually go for it. We looked and we studied the market in the state of Arizona. Most of the payday lending industry service providers in the state actually are from out of the state. So in terms of the business in and of itself does not generate revenues for the state. And the predatory practice of it actually affects Latinos and Native Americans in the state more so than any other population. By election day, the electorate had said no to payday lending by a margin higher than 60%. Thank you. In the area of mortgage, our projected foreclosure impact in the United States just this year, 2.4 million foreclosures. And over the next 4 years, again, conservative numbers, lowballing again, 8.1 million foreclosures, and loss of home ownership, changing home prices, as well as home sales, and assets for people across the board that are associated with this crisis. Very, very significant. As it relates to foreclosures in Latino communities, the top 16 states in the country suffering from both the foreclosure, loss of home ownership, as well as the loss of home values are states where Latinos reside the most. So they are disproportionately, just like my brothers and sisters from African American, Native American, and Asian Pacific descent, they are disproportionately affected by this crisis. I also have to mention that the way in which we treat immigrants in this country also complicates and exacerbates the situation as well. There are many states across the country that have enacted anti-immigrant laws and scapegoating the immigrant population for the economic woes that we are going through. There has been some argument made by some pundits that it is in fact immigrants who receive mortgages that have taken this country to bankruptcy. What a fallacy, and they actually think that we are that gullible because the I-team lending product in the market is not even a drop in the bucket, and as a matter of fact is the strongest product in the market. In terms of legislative, I'm going to leave those remarks there. In terms of legislative opportunities that we have immediately, we have to continue to deal with this foreclosure crisis. We have still on the table and being discussed the judicial modification law, which is stalled in the Senate. Apparently, some senators, have not yet seen the light. So I invite you to invite your communities, your networks from across the country to apply some fire to those senators, because without the fire, they will not see the light. We anticipate some movement on this particular proposal upon the return from the Easter recess, or spring recess, I should say, around the 17th. We also have and anticipate a mortgage reform. We anticipate a mortgage reform bill to be introduced promptly, and there is a big desire to actually move this piece of legislation very, very quickly. Only one piece that I like to focus is YSP. Has nothing to do with being young, single, or anything. It has to do with the steering of consumers. And steering doesn't have to do anything with vehicles, but actually taking consumers the wrong path in financial markets. I can comment some more about other pieces of legislation, but we will have Q&A. I'd just like to close by telling you and sharing with you my always personal story, because I think that this is about people. It's not about statistics. It's about us. And so my daughter is a punk. I have a 20-year-old daughter. She is the descendant of Native Americans, black slaves, and immigrants. She has the audacity to defy every stereotype about any of these population groups, and she should. She successfully completed high school. She has delayed motherhood. She is pursuing higher education at a great academic institution, and she has also had some bumps along the road in terms of managing her finances and credit. However, she is doing better because of homeownership, because of education, because there are systems that have supported her through a great deal of struggle. I think that every single child in our country should have the right to decide to be a punk.
You know, Aracely had to restate her name because she says it so much more elegantly than do I. All right, Jose, and I'm going to ask that the speakers try to remain within 10 minutes just because we're running so late, starting so late today.
Help me up with that, Jim. It's great to be here. It's great to have this, bring this energy of closing the racial wealth gap in the halls of Congress, where it's so needed at this time. I remember the first time that I was part of this committee in Santa Barbara, where we actually were talking about Professor Oliver, Jim Carr, myself, and many others mentioned about payday lending and mortgages and how this will have a devastating impact on communities of color, and sadly have done it. But what I want to bring that up is that communities of color put themselves particularly in a hard place because this have been 30 years of disinvestment. This is not a story that started with the foreclosure crisis. This is a story that started many years ago, easily a decade ago, with stagnant, as Congressman very eloquently mentioned, stagnant wages as productivity has gone up. Lack of safety net, health care with not being provided to our fellow members, unemployment insurance not being sufficient to deal with this. So the erosion of lack of safety net, stagnant wages have definitely assisted the process of decreasing the only asset that many families have, which is their home equity. I bet you remember in the midst of the 2000s when home values were going up like crazy, people were, the ATM home equity. But as part of that home equity, a big part of that, almost 50% based on federal data, it's that it was being used to pay credit card debt. And a lot of that credit card debt actually was being used to pay for cost of living expenses, job loss, and the medical debt, as we all know it. So this have been a spiral. I think that we have recreated a society in the last decade, a debt-based society, a plastic-based society, not only in this area, but in the areas of education, so important for our society in general, that we actually are putting our young people into debt just to go to higher education, when that's not the reality. I mean, I went to college here in the state, and the first experience that I had with debt was actually through my mortgage and my educational loans. And I learned quickly that this is not the way historically that this society have paid for higher education. That they actually were the bill 1965 that actually assisted many people to go through college that communities of color never benefited as others. So, and it actually created the middle class. So we're in a transformative, everybody keeps saying the same thing, but I think we're in a transformative time. This recession lead us to a particular place in history that we can change the route of where we're going. Today, and I think credit plays an important role, a critical part of this story. Credit have been necessary for building wealth. Credit have been one of the main ways that we have built wealth through our homes. It assisted the process of building wealth by buying a car. It assisted the process in this current scenario to go to college. So it is either a way of building, a main wealth for many low and middle income Americans, or it's a way to get there. You use your car to go to your job, correct? But that, John Powell said yesterday very, very nicely, is that we're in and the image that comes to mind, we're in an uneven playing field. How would you expect that in an uneven credit market, you were supposed to straight up, go ahead, and no change in the credit market, right? Like we just expect the credit market to be there. It's a private industry, and we should just use it as it is, and and just use whatever is available. which is, I think, incorrect. You know, we need to change how the industry do businesses, because this is the livelihood of our country. It is like going to the electric stairs, and we keep moving in the same place. And that's the image that keep coming to my mind. You know, I can go through the plethora of policy from FHA that many of people here know very well. Redlining 1950s and the current deregulation financial market that actually have a lot, you know, in our communities, what sold the deregulation of the lending industry as the means. I mean, I think for they sold it to us like it was the new social policy was going to be our deregulation financial market. Greenspan, we heard him many times talking about how subprime mortgage will get us there. You know, as we know, it's a different story. It actually supported a dual financial market. From place-based disinvestment in our communities on payday lenders and buy here, pay here auto loans to a more sophisticated credit card industry that doesn't need to be in your neighborhood. Fed's data actually stated that based on neighborhood where you live, 80% or 65% or more that people that live in a particular communities of color have less access to credit cards. But at the same time, other research mentioned that those credit cards that are given or market to those communities have higher interest rates of 20% of higher demos. Center for American Progress have done. Christian Weller have done excellent research on this, mentioning that linking in particular to deregulation actually didn't assist the process of increasing credit, but it made it more costly. And from that, we moved to the credit card that have, you know, fee harvesting. That CRL have done excellent work on that. Actually, you know, just to get your credit card, you go to half of your credit limit. And it's incredible money that being charged. So is, you know, what are these lending instruments are doing to our communities? So I'm going to give you some sense that how this innovation have increased debt and why is that debt have increased so much. For African American Latinos, not necessarily have more credit cards than other communities, but those that have credit card have more debt. In 2000, the Survey of Consumer Finance data, for us geeks, the 2007 is already out there, so we're already working on that. Have higher percentage of the 84% of African American 2004 have credit card debt, and Latinos 69% compared to 53 white counterparts. And the amount of credit card debt, this is actually new data that we're actually producing based on a survey funded by the Ford Foundation. We found that the amount in 2008 the Hispanics have $12,000 in credit card debt. This is for low and middle income Americans. White have 9,888 and black 730 and 394. I think the story for African Americans and Latinos is not necessarily how high is their credit card debt, but particularly what is in comparison to their general assets and how much of the money of the credit card debts goes goes to pay debt, which is horrific. The amount of households of color with 20% APR or higher, this is based on the same survey. It with 32% for African Americans, it's higher than Latinos or whites, and 29% followed by whites of 22%. And why are people getting into credit card debt? As I mentioned before, we asked, the main question is do cost of living increases is actually assisting the process of getting into credit card debt due to low savings. And 38% of Latinos says that that was the case. 41% of blacks mentioned this as the main reason to getting credit card debt, and 37%. So it's very much equal. We did a regression analysis to see if how credit card debt compared to incomes, those that have high credit card debt compared to their income, because it's not the same to have a high credit card debt when your income is very high, which is usually you can take those cars and go crazy if you have very high income. However, for low and middle Americans, Cost of living and job loss is the main reason that they go to credit card. Not the main reason they go to credit card debt, but that they have a high incident credit card debt compared to their income. Another important factor has to do with giving money to relatives. And this is a story that we see a lot in communities of color. You know, I think Derek Hamilton and others have done excellent research in this area of how group, networks of people we're one of the few of those with middle class, and we have to then help our brothers and sisters, and there's always one that always need help. And we always put in that credit card. Thank you. So, moving forward and looking how debt have been so devastating, I think that I'm going to move a little bit forward than what our other panelists are talking. I'm talking about some great stuff that is going on actually in the Financial Committee in terms of credit card debt. The credit card bill of right proposed by Maloney, I think, is a great credit card bill that put forward. Senator Dudd have another credit card bill, the card to 2009. I mean, these are two great bills. Hopefully, something that looks similar to these two bills will still be great. The Federal Reserve Board also put some regulations, rules that will be applied in 2010. That's one of my main critiques. Why wait so long? We did them now in the midst of this recession. And one more thing. Well, I have the Financial Product Safety Commission that is putting forward by Elizabeth Warren, and actually Durbine, Congressman Bullurman is putting forward. It's basically, it comes to the general assumption that we as a society and as a government, we protect our people, right? We don't let toys with lead in the streets. We decided that certain drugs are not good to be in neighborhoods, so we control that. So we should do the same with financial products. Not every single product should be out there because it's harmful for communities. And I think this is a great initiative. I think something that I will add, and hopefully we can work together, is that I think that this commission needs a racial lens to it, to look into this, particularly how this affected communities of color. We need data not only in mortgages. We need data for auto lending that looks into race and pricing mechanism, and credit cards, in a wide variety of areas, because if we don't do this, it will strip what we have, and anything that we can gain for mortgages. I think that I think CRA modernization it's great, and I know Jim is on the ball with that, and I think it's moving, and how it's shifted to financial industries, and have, I know, some provision on credit card and payday lending inside. And I know, hopefully, we'll talk a little bit more about the FDIC and credit unions, how we should support those institutions that once and time and time over actually come through for our communities. Thank you very much.
Thank you. Well, good morning. It's really an honor to be able to address this group of committed people that's trying to expand economic opportunities, particularly for all of our communities. And as we all have said time and time again here, of course, we seem to be the hardest hit in these economic downturns. And our communities have never gotten up from the downturns from before. So I want to follow up with something Jim said about us all working together as a community. I really appreciate the invitation. There's a word in my language, Tlingit language, it's wuxin, and it means where we all come together. And really the word stems from us lifting up the totem pole together. One of us couldn't lift it without each other. And I appreciate the extension of Indian country to be able to be part of this panel and part of this forum here today. And of course, there's many friends I see in the audience that have many of you that I've known for a long time. I know you heard from Rebecca Adamson yesterday about innovative approaches and to offer solutions with indigenous peoples across the globe. And I know that later this afternoon you're going to hear from Tanya Fiddler about some of the work that she's doing on Cheyenne River in one of the poorest counties in this country, and it's just great to see what she's been doing there. But first I want to start with, as Jim said, I'm the Executive Director of National Congress of American Indians, which is the oldest, the largest Native American organization here in Washington, D.C., representative organization representing all of Indian country. It was created in 1944. We actually represent about the group collectively about 562 tribes and Native Americans, their membership. And the purpose of that was because we wanted to be able to make sure that we had a voice in Washington, D.C. where policies being made that affected us. And also, the premise of when we got started was the number one foundational principle was that we were going to protect sovereignty. And I wanted to just bring that up because that is our number one principle. And then you ask, well, why am I talking about, financial issues? Well, the Constitution recognizes three sovereign governments: one, the federal, the state, and the tribal governments. And I don't ever want to forget that. And because we are uniquely situated, that means that we're not only, a minority group as considered in many, many venues, but we're also a political subdivision. It also means that we have some unique opportunities and unique challenges. And I want to focus a little bit about those. But with the unique opportunities, I think when we look at, and what I try to tell tribal leaders, particularly in this arena, in order to be able to protect our political status and to be able to, rally for and be the governments that are supposed to be able to provide services for our citizenry, just like any other sovereign nation, we have to have financial power. And this is where Indian country sorely lags behind. We don't have a tax revenue base. We aren't like other governments that tax. So we have to be able to use our financial investments and wherewithals and our revenues to be able to help provide the revenues for our governmental systems. But we want to talk about, and you've shared some stories about the mistreatment of communities of color in regard to resources. But I just want to once again remind you that many of our challenges came many, many years ago when the first European boots came to the shore. In fact, one of the first policies that affected us is the Homestead Act. And the Homestead Act was really just a policy that that confiscated land owned by the Indian people and offered it to a diverse group of white men. And as our land was stolen, women and African Americans were excluded from the opportunities to become stakeholders in America. And regrettably, policies like the Homestead Act is not is not the same as in Native American communities as other parts of America. Well, policy makers point with pride that the American middle class, and to fight to preserve it, our communities, like your communities, are faced with some of the poorest conditions for generations that have unparalleled any economic downturn. We talk about the unemployment percentages. I want to remind folks that even in the 2000 census, unemployment on reservations was at 22%, and that was aggregated nationwide. Yet we know that in many of our parts of the communities, 80 to 90% unemployment is not unprecedented. Even the unemployment rate during the Great Depression was 25%, and Indian country, in many, many communities, 25% would be a landmark. And so when we look at the per capita income for American Indians and Alaska Natives living on reservations was about $7,942, merely about one-third of the U.S. average for all races, which was $21,587. Unemployment coupled with low income, average income wages means poverty rate for most Indian families on reservations, which is about 36%, which is 2.5 times the national average. I know there's a lot of stats, but real just quickly, I want to just say 17% lack telephone service, 12% lack complete plumbing, and less than 1% of the population have any of these, only less than 1% of the population lack any of these facilities. There was a story just recently that was printed in a lot of the AP news about Tuluxat and Emonic from Alaska. I'm from Alaska. And there was a tribal administrator who was really concerned about the tribal members' ability to even pay their basic utilities. And they had to make a choice between having power for heating in their homes or to be able to have food on their table. And so so those are tough challenges that our folks meet in the villages on a regular basis. But when it gets to financial literacy and financial mainstream, I want to remind folks that Indian country, 86% of Native communities lack any kind of single financial institution. And we're talking using the term definition, an ATM is a financial institution. And so we see a lot of fringe financial companies aggressively marketing our communities, and as they get shoved out of your communities because you develop laws, they come towards us a little bit closer. And so in communities like New Mexico and South Dakota, it's really easily when you explain that many banks are just simply not there, and so the only institutions are the payday lenders, the predatory tax preparers, and the list goes on and on. We've worked with organizations to try to be able to address those things, and we encourage tribes because of their political subdivision and their ability to develop their own laws and ordinances, to develop predatory lending laws, and to be able to start to address those things. But those are really challenged, as you know, when there's absolutely no access to credit markets. So the couple things, recommendations that I'd like to leave is we found that things like CDFI has actually flourished in Indian country. We have almost 50 certified CDFIs. I created one of the first ones that was certified for Indian country. And those are institutions that are actually making differences in our community. And one of the reasons why they're making differences is because they come from the community. Self-determination works really good for Indian country. Laws of self-determination and policy make big differences to us. So when we look at laws and ordinances and other kinds of political legislation, we're looking for ones that promote the rights of tribes to be able to determine how it works within their own community. NAHASDA is a good example of that. I was the former Deputy Assistant Secretary for HUD during the implementation of NAHASDA, and formerly the chair of National Marketing and Housing Council and development of NAHASDA. The whole point of NAHASDA, Native American Housing and Self-Determination Act, was that the federal government invested into the tribal communities and we determined the housing products. They were no longer determined by HUD. We determined how we leveraged those monies. We determined what we needed to do at the local community. So as we look forward, I want to remind folks that as tribes sit at the table, we're looking for those products of self-determination. Thank you.
Thank you. And I hate to rush the panelists so much. I had created a 0 minutes for Jacqueline, and I was feeling real anxiety because the statistics are they're just unbelievable. And when you combine those with Jose's, it goes back to something that Aracely said, which might sound radical until you actually think about it. Thank goodness the system as it was is gone, because it wasn't working. And the way you know it wasn't working is the statistics that the panelists have put forward. If you think that that was a good outcome, then yes, we should celebrate the system as it was and be real remorse. But there's no remorse for what that system was. In many respects, it was the great Titanic just looking for an iceberg and eventually would find one, because it was severely designed and completely recklessly being operated. And that is what we had as a financial system that was creating earnings and profits and revenues that were smoke and mirrors. And that smoke and mirrors aspect of the financial system actually represents a real challenge for us in communities of color, because so much of the economic opportunity that was created around all the smoke and mirrors is gone, and it's not coming back. So the question is, what fills that big hole in the U.S. economy? And that is another challenge that we have to deal with, because many of our communities need jobs that have left this country. And so what and how do we deal with those issues? Not to complicate things and not take up any more time, but I don't know how much time we have, Kalolo, but it would seem it would be helpful to at least allow the audience to ask a few questions of the panelists if we could.
Hello, and thank you very much for all your comments. Just a quick point and then a question. I'm glad that so many policymakers were able to come and speak to us, but the solutions that are most commonly mentioned by them, financial literacy and lender liability, while important, are unlikely to change the underlying facts that The common financial institution in most of our communities are check cashers and not banks. There's widespread discrimination in all parts of the housing market and credit market. And many of our people pay segregation taxes if we do own homes, and they're unlikely to address or even come close to shrinking the wealth gap that we've been talking about. So how can we get these policymakers to not only come and present, but to listen and champion some of our solutions?
I'd like to mention, thank you for bringing that to the forefront. I'd like to mention that Senator Durbin has a 36% rate cap, and 36% sounds usurious under the circumstances, but compared to 400% payday loans and over 1,000% overdrafts and high cost of credit cards, 36% is actually more bearable. I think that under the current economic conditions, I would be of the preference to go for no more than 18, but if we can't get it done under the current economic conditions, we certainly wouldn't stand a chance. So the bill has also been introduced on the House side, and so I expect more conversation on the usury cap.
And I think you raised the question that you raised is an issue of regulation, but it's an issue of workforce regulation, it's an issue of employment regulation, it's an issue of financial regulation, it's an issue of investment, of space-based investment in communities of color. That we need to position ourselves. I think that's what you're getting at, to get how this recovery package and next, and as we move forward to local investment, how we make sure that we get, as a congressman was saying, I just want a fair distribution of wealth. And I think that the job that we need to do, it's going to be a lot in federal level, but it's going to be in our state levels. And the state levels commission are being created to see how this money is going to be allocated. And we want to have to make sure that those of us that have in the spaces of power to be those commission, and those that are not, be advocates for that. And big decisions are going to be made in the federal and state level. So we have to be mindful all the step of the way, not only how policies are created, but as you know, implementation is key.
And just a quick comment. I think what we need to recognize is that it's not an either-or menu. Yeah. It's an all, every, absolute. Because these wealth disparities were created from centuries of denial. And we won't get there by saying, okay, well, now you pass CRA, that's it, now we can go home. Or credit card reform, okay, go home. We have to enforce the laws. We have to be creative in our thinking about economic recovery. We need to be looking at everything from jobs to what jobs pay, to who owns those jobs, to how you save for retirement, to do you have health care, to all the way through to access to credit. And any piece of that puzzle that we leave off of the table is going to be a major failure, because that's where the opportunities will disappear. So it's an all-inclusive. You can't get there, and you have to enforce the laws. Enacting them is the first step. Enforcing them is equally important. We'll take a couple more questions. Mitty?
Thank you for all your great insights. The congressional reps bemoaned the fact that the federal government did not pick up the progressive anti-predatory laws from states like North Carolina and apply that, nationally. But not only did they not pick it up, they actually allowed the federal preemption prohibiting states that did want to act progressively from doing it. And I'm surprised that the congressional reps didn't speak to that. Could you say a word about that, and say a word about the forces that we're up against, the particular vested interests that are opposing things that even the mass majority of the populace on a local level clearly want? Let's identify who are these forces that are opposing this that we need to really focus in on and make sure we defeat.
I was going to say, Jim, you would clear the floor with that.
I'm trying to be the moderator. But if someone doesn't speak.
10 years ago, in my first year at the Ford Foundation, I heard Jim Carr at a Federal Reserve conference lambasting the regulators for not extending regulation to all these subprime, fringe, irresponsible lenders. And I have to just say, when one of the representatives said no one was speaking to this, no one expected this, not only did CRL, but Jim Carr and many other advocates saw this and were speaking directly to the federal government, to the regulators, and they didn't pick up on it.
So the question on the table is, who are the powers that prevent real reforms that the populace want and need in order for markets to be effective and efficient? And the reality is that the financial institutions that have brought us to this point have so much amassed wealth in a troop, armies of lobbyists walking the halls of Congress, also writing maximum dollar amount political campaign contributions that influence the way in which policymakers vote.
Aracely,
Yes.
do you want to explain the preemptions? I don't know if everybody knows what they did.
Well, the national regulators, there are a couple of national regulators that oversee national institutions. The OCC is the regulator for national charter banks. And when the anti-predatory lending legislation from North Carolina was enacted, it got involved in some cases, court cases, where it actually overruled the state's right to actually regulate banking institutions as they were performing predatory practices at the state level, in taking then those rights away from the states. In essence, the OCC has become a complicit in the practice of predatory practices across our country. Do you want to elaborate?
I mean, basically, what they took a obscure law, it was 1935 or something, that they find that basically all regulation will be done at the national level, when there was already a great movement in the state level to regulate predatory lending, North Carolina, New Jersey, and the list goes on that was being done in that level. And they said, well, we're going to take it on a federal level, and we're going to leave basically our friends handle it.
And the same thing has been done by the Office of Thrift Supervision.
And I'll just add one thing. So far, I've gotten AIG and Bernie Madoff in my comments, so let me add Watergate. And so, Biddy, let me answer the question by saying simply this: follow the money. Where is the money going? There you know where you have your resistance. And the solution is that we have to encourage communities to mobilize, because what we did in November was mobilize. And that is why we have the change in administration we have. And the president said on election night very clearly, this is not the change you seek. This is the beginning. And he encouraged us to help him. And in fact, way back years ago, Roosevelt said, I understand your issues, now make me do it. And so I think we need to steal a page from the history books and recognize that our work has just begun. We have a very actively hearing administration and lots of members of Congress who want to do the right thing, but they are facing an extraordinary amount of political power, as Aracely pointed out, and the only way we can counteract that against those trillions of dollars of wealth that have nevertheless been obtained and they still hold is to mobilize and be active and make the point that we're willing to vote. We're willing to vote. And when we point out we're willing to vote, that's where we will get the change that we seek and we demand. And was that it? Okay. Thank you.